Dow lost nearly all of a 400-plus point gain to end basically flat. The move comes after Governor Andrew Bailey urged pension funds to rebalance quickly, saying, quote, "My message is you've got 3 days left now. You've got to get this done." He added, quote, "The essence of financial stability is that intervention is temporary. It's not prolonged." So what's your take on this deadline and the market's reaction to these very dire words, Tim?
Look, the minute you start talking about bailing out UK pension funds and that there's an organized central bank intervention that wasn't about a central bank losing its resolve, this wasn't about central banks running back in. And that, look, a lot of people thought that this was a case. How could they be buying bonds while they're cranking up their budget and making things look a lot more difficult for their currency? But that's as a function of those things. They referred to the fire sale dynamics that they were in there to defend. So what seemed like last week, it was just a central bank trying to put some order after the prime minister went in there, when in fact this is really the culmination of months of volatility in gilts and in the UK, but in sovereign debt around the world. We talk all the time on this show about the most liquid asset classes, but those that are the most levered. So again, you want to talk about too big to fail. I mean, UK pension funds effectively are that to the UK. Nothing like your central bank governor basically calling out to the world that you're scrambling and you're trying to sell positions that you have margin calls on. Not so good. And it doesn't get better from here. And again, we're now using those acronyms again. Yeah. CLOs. We're talking about the collateralized leverage obligation market, which is $1 trillion in size. And today was a very big headline and on some level, a new leg to this journey that we've been in with markets over the last 15 months.
Yeah, part of the key to understanding this whole pension story in the UK is understanding that what they have there, a popular investing strategy on the part of pensions, is a liability-driven investment strategy, which is basically defined benefits. So they guarantee payouts. And so what has happened here with this turmoil going on in the UK is that they've all of a sudden got a huge hole to fill when it comes to the value of their bonds. And these strategies, you're pointing this out, they are leveraged strategies because they use derivatives here as an overlay.
They've got to. That's really the only way that you can guarantee that you don't fall below a certain threshold or go above a certain threshold. And I think really what's been holding markets up somewhat and have kept people from absolutely running from the doors is this notion that there is not financial contagion. This time is different. And everyone has said, this is what's different. Well, I'll tell you, if you see volatility in sovereigns, that is the underlying pricing mechanism for every other financial assets, whether it be mortgages or credit or whatever else, or even if you're looking at equities, you're definitely going to look at equities vis-a-vis what you can get in risk-free. And so the next point is, who is the next buyer aside from pensions? That is, aside from the central bank, that is one of the largest buyers of index type of security. So, I will understand the BFE saying this has to be a temporary intervention because you don't want you don't want it to appear that markets are being manipulated. But I would argue that fiscal policy, rather monetary policy for the last decade has been kind of put where we want it to be. So, it's a fine balance between short-term solution and just understanding what the medicine truly is going to be and what it's going to take to provide stability.